All right, I'm here.
Okay. Just lead us off then.
Good evening, everyone. My name is Greg Wetzel, and tonight I'd like to have the opportunity to introduce Rich Clouse. Rich has been a longtime friend and colleague and is very knowledgeable in debt management and unique ways and strategies in protecting and growing your income and developing wealth over time. So, Rich, it is all yours.
Hey, Greg, thanks a lot. Hey, thanks everybody for joining us tonight. It's still a pretty cold day and towards the end of February 2019, but it was sunny today, so that makes it a heck of a lot nicer here in the Ohio area, that's for sure. Hey, tonight we're going to do something a little bit different than we've done, in the past. We're going to really talk about a money lesson. And what we want to get across here is there's really nothing good or nothing bad in where you place money. But you need to have knowledge before you put money places because it can have adverse effects or unintended consequences when you don't know what's going to happen. So we're going to go through a few things and then talk a little more detail a little bit later. But again, we'll be 30 minutes or less tonight. Hopefully we'll have some questions come in. I have some extra thoughts if we don't get many questions in tonight. But let's just start. I don't know why that thing came up, sorry. What type of risks do you take when you're putting money in various financial products? One of the first things we try to educate all our dentists about is very simply, there is a difference between savings and investing. The investing, and a lot of people just say that that's one and the same, and it's really not. Because when you save money, basically you can't lose any money. You're saving it, it's guaranteed. In today's world, you might not get a real big interest rate, on it, but it's safe. When you're investing, you bring in, right there, the risk element to it. Nothing wrong with investments, nothing wrong with savings. Too many people we see through the years have started out investing before they have that core of safe money that they can fall back on if they need it, either for opportunities or possibly for situations where something has gone wrong from a financial standpoint. One of the other risks in the products is time. When you put money certain places, there are requirements to leave it there. A very simple example is a CD. If you buy a 2-year CD, that money's tied up for 2 years, or there are losses if you need to go get that money back. If you put it in some of the products like we'll talk about in number 2, IRAs, 401ks, simple plans, there's other governmental restrictions, on it. So time and access to the money is extremely critical to understand. The other piece is taxes. Some places you put money, you're not going to pay any taxes. Some places it'll grow with no taxes until you decide to take it out, and then you have to worry about taxes. So understanding the tax liability or potential tax liability when you're putting money some places is very, very important. So when we get to number 2, most of the dentists we talk to either have been in practice for a while or just getting started. One of the things everybody's after them to do is put investments in IRAs or other types of retirement plans. They could be Roth IRAs, they could be 401ks, they could be simple plans, they could be SEP plans. All of them, they're called qualified plans. And the word qualified just means the government has put the rules and regulations into that. And what's important is to understand what access do you have. You'd be amazed the number of dentists that we talk to that say, well, I put that money in, I can get it back out, it's my money. Well, it's not your money. It's basically the government's money, and the government is in control of it. Any of you that have read our book or heard anything, we talk about we want to put the luck on your side. And what luck means is liquidity. Okay? That means you have access to get your money. If you have it in an IRA, do you have liquidity? The answer is no, not without governmental controls on what's going to happen if you take the money out. The U stands for use. Could you use money from an IRA or a simple or a 401k plan to, say, put a major down payment on a house? The answer is no, not without tax considerations. And the C stands for control. That means Do you have control of the dollars that are in those accounts? And for the most part, you don't. The primary age that's important to keep in mind is age 59 and a half. If you want to take money out prior to 59 and a half in those type of investments, retirement plans, you're going to have to pay ordinary income on top of your other income for the year, plus a 10% penalty. Again, nothing wrong with putting money into those, but you need to determine from a timing perspective and the accessibility, is that the right thing for you to do? An example, if you have a lot of student loans out there or a lot of practice loans, does it make sense to tie money up when you're still paying principal and interest payments to others in the banking world? Again, nothing wrong with it, but we need to understand. Number 3 is, what is the tax treatment when we take money out of various products? So, as an example, there are what are called non-qualified investments. I already said qualified investment is a retirement plan that the government sanctions and has all the rules. A non-qualified investment, very simply, would be something that is not subject to governmental rules. That's not to say it's not subject to taxes, but it's not subject to the governmental controls and maybe penalties that are out there. Other people talk about mutual funds. Okay, what's the tax treatment of a mutual fund? Well, a mutual fund will earn and pay dividends and capital gains pretty much every year. Well, when that happens, you have to pay income tax on it. You may not get the money because you've reinvested it in that mutual fund, but you're going to get a 1099 this time of year and have to put that amount of money that you earn on your tax return and pay income taxes on it. There could be real estate. Well, real estate, it grows with no tax against it. You have tax write-off if it's a business, if it's a practice building, you get to depreciate it and save some taxes with it. Once you do sell that property, for the most part, if you've owned it for more than 12 months, you're going to get long-term capital gains taxes, which are significantly less than ordinary income taxes. So the whole point with this is, before you put money in any place, you need to understand how long it has to be there, what access do you have to the money, and then also what the tax implications would be once you want to go get the money for something. So moving forward, let's talk about risk of dollars. So as we put money in, if you remember from our last one, we've got our house of money there. You know, the show that's on, the House of Cards. This is the house of money. That's your money. And what you have to be aware of and want to avoid is, you see the dollars up there kind of floating away in the top? Well, that can happen. Doesn't have to happen, but it can happen. So let's take a look at where you can put money and what the risks are. So the risk of your dollars up here. But over here on the far left-hand side, full market participation. What does that mean? That means if the market goes up a lot, you're going to get a big bang for your buck. You know, a few years ago, the market was going great. 2018, not so good. The last quarter or so of 2018, that full market participation meant you probably lost 10 to 15% of your money during that quarter. Well, what is subject to the good pieces and the bad pieces of the full market? Mutual funds we just talked about is one. A separately managed account. That's typically where you go to a stock brokerage firm and they take your money and divide it up into a number of different types of investments. They could be all stocks, they could be all mutual funds, but it's kind of a housing of various products all managed separately for you. Individual stocks, you have all the risk there. One of the advantages of an individual stock is you don't have the ongoing tax liability unless you elect to sell them. So a lot of people, particularly as they get more and more money, will try to have a portfolio of individual stocks so they can control the tax liability. If you have asset allocation portfolios, same thing. You might have some bonds, you might have some U.S. stocks, you might have some stocks outside the U.S. But all of these, variable annuities. The investment side of a variable annuity basically is in mutual funds. Variable life insurance, that's basically a regular life insurance policy, but the pieces, the underlying cash value or savings in the policy is invested in the stock market. So all of these in that left-hand side are going to be subject to full market participation, whether that be good or bad. Again, as I said earlier in the first page, that doesn't mean you shouldn't do that. It just means you should understand that you're making investments and you're going to be subject to whatever that market fluctuation is, good or bad. So in the center here, Then we have market participation with guarantees. Well, what the heck does that mean? Well, the first one was full market participation, meaning if the market goes way up, you're going to get all of it. This one says market participation with guarantees. Doesn't take much thought pattern to realize if you've got guarantees with something, you're probably not going to get all the upside of the market. But with guarantees, the type of products that have that, there are fixed indexed annuities. And our time isn't enough for me to fully explain that, but what that really is saying is your money is invested in indexed options where you can get the upside potential if the index performs well, like the Standard & Poor's 500. But if the Standard & Poor's doesn't perform well, your worst year is a 0% rate of return. You can't lose any money. So you've got guarantee of principal in that. The variable annuities that we talked about on the first column over there, some of those come with income guarantees. What that means is if you leave the money in there, it's going to guarantee to grow and guarantee to produce you an income for the rest of your life. You're giving up some upside market potential, in that, but you've got the guarantees. Fixed indexed life insurance, basically, unlike the variable over here where your money is fully exposed to the good and the bad of the stock market, indexed life insurance works very much like the fixed indexed annuity we just talked about, where 0 is your worst year. So if you had $100,000 in cash values in one of those and the market went down 20%, you wouldn't lose a dime. Your $100,000 would still be there and could grow the next year. So a lot of people like this middle column because it gives them some of the upside protection, quite a bit of the upside, but the protection on the downside where they really can't lose any money. The far column is fixed income. These are more like savings accounts, just like we have right here. Those are ones that principal in almost every case is guaranteed to a certain rate. Now, in today's world, that rate of return, that interest that's up here, is not very high because we're in the lowest interest rate environment we've ever had in our country. That, again, doesn't make any of these things bad that are in here because safety is very, very important to people. And typically, as they get a little older, they don't want to take as much market participation as they had when they were younger. So the other things would come in. Fixed annuities basically let you have deferred taxes as your money grows, but it has guaranteed interest rates very much like a CD would have. Government bonds, corporate bonds, they're pretty darn safe on most of them. The type of life insurance, whole life coverage that we talk a lot about with setting up the cap plans for the cash value so you can be your own bank, basically that has a guaranteed premium, guaranteed death benefit, guaranteed cash value, so the word guarantee is everywhere. The higher interest rates are, the more your cash value is going to be there because the cash value grows based on the investment interest that the insurance company can earn on government bonds, corporate bonds, and things like that. Current assumption universal life basically just says that the cash values are going to be tied to like a money market account. And when money market accounts were really high in the 80s, people were making 12% or so in it. In today's world, they're probably making 3%, if that in it. But all of these are different spots, and you need to decide as you start deploying your money in places, how much risk do you want to take on those dollars? And there's no right or wrong answer. And as I've told clients for the years that I've been doing this, I don't think anybody knows their risk tolerance until they lose their money. And then they start thinking in terms of how much do I want to risk? And some people risk it all the time. And again, nothing wrong with that. So as we go on, you've seen this before. Where do you want your money to reside? This is kind of a combination of what we just went over. If we have money over here in our yellow accounts, these would be basically qualified. Oops. That's really not a very good spelling there, but qualified accounts as IRAs, 401ks, pensions. So from our previous screen, you now understand all of those pretty much are going to have some risk to them. But the other piece is you pay your taxes as you withdraw the money. Our concern is we feel that income tax rates are going up, that they can't go down. So what we're doing today in many cases is we're choosing to postpone the tax today, say in 2019, and pay the income tax when we take the money out in, say, 2040 or 2045 or 2035. at an unknown rate. That's what scares us from a client perspective, because a majority of people, when we start working with them, when we ask them how much of all their money they have set aside that are going to produce dollars for them in retirement, how much of it is in that yellow bucket? And some of you already know the answer to this, but in many cases, it's 80 to 90% of their retirement money that they're going to use to live on is in that yellow bucket. Well, they've got a lot of potential risk from a tax liability standpoint. So as we move over to the blue bucket, these are dollars you've already paid tax on, and you put them places to grow. Now, the good news and what we try to do here is be able to help clients get long-term capital gain taxes, which are significantly less than ordinary tax. Some people in the U.S. today are in a 0% long-term capital gains. A majority of people are probably in a 15% long-term capital gains. Now, the very, very wealthy are in a 20 to 22%. But all of those are significantly less than what you would say ordinary income would be taxed as. So other things could be in there. Stocks would be in there. Mutual funds would be in there. You're getting some benefit of taxes, plus you have access. One of the other big things that can be in there is real estate. Real estate can produce tax-free income, depending upon what other write-offs you have from a depreciation perspective, et cetera, on it. So the blue bucket gives you tax benefits and access. And as we've talked before, access to dollars is really, really important at various times. So our green bucket, as you all know, what we're talking about here is tax-free, both tax-free access, tax-free income. And the three components that really make that up are Roth IRAs. Those are really good long-term, but you don't have any access to the money basically other than your deposit up until you're 59.5 without the same taxation of ordinary income plus 10% penalties. I'll go to municipal bonds. Municipal bonds, the interest earnings there are income tax-free. However, the interest earnings today on municipal bond are not very good just because we're in that low interest rate environment. Excuse me. See if I can get my throat working a little bit better. Our cap plans that we talk about for our dentist clients to manage and loan money to their practices using the specially designed life insurance cash values have unlimited amount of money you can put in. You can develop as much tax-free dollars that you can utilize between, say, today and 59.5. No penalties at all for taking that and using it. You can pay it all back, and then it will continue to produce you tax-free income going forward out into retirement. So using the same money over and over again. Most of you have seen this. This is the history of the United States income tax. I'm not going to spend a lot of time with it, but the important thing to look at is we didn't have personal income taxes until 1913. And it basically was a 7% top marginal bracket at that point. As we always say to everybody, man, wouldn't that be nice if we could have that today? Why have taxes gone up? The end in the late 19-teens, 1917, 1918, World War I. Taxes went from 7% up to 73%. And as most of you know, that doesn't mean you paid 73 cents on every dollar you made. There is a threshold that the government has and has always had in there. Anything above that threshold for that year, you would pay on the next dollar 73 cents. You can see it went down to 25% right towards probably the mid-1920s. Well, the stock market crash hit. We went into the Depression. FDR was elected president, tried to get the economy going and the country going again. So he started work programs, Social Security, bridge programs to get people back to work to be able to get them some income. Well, those are social programs. They cost money. Taxes went from 25% up to 63%. After the late 30s, early 40s, we had World War II. They had to pay for it. Went up to 78%. The highest bracket we've ever had for marginal tax bracket is right at the end of the war, 1945, 1946, that it was 94%. And a quick story, most of you have heard it, there was an actor that made movies and he got paid $100,000 per movie. And he only did 2 movies a year because the threshold was $200,000. So if he did another movie, he lost 94 cents of that to taxes. So it made no sense for him to do another movie. After World War II, rates went down. They went back up for basically Korea, which is interesting that Trump is meeting with the Korean president in Vietnam today to try to work on some other things. So Korea has been involved with the United States for a long time in a lot of issues. After that, income taxes went down. The blip there is Vietnam. When President Reagan was elected in 1980, his goal was to reduce the 70% marginal bracket down, which he did. And the interesting thing, it's the same actor that only did 2 movies when the threshold was at $200,000 and 94% marginal bracket. And the desired result that he thought would happen did happen. The economy boomed in the 80s because people were not paying 70 or 50, they were paying 28% for the highest tax bracket. The 40% were the Bill Clinton years, the 35 were the Bush Jr., the few blips here were the last increases from President Obama. So the whole point of this slide is, why have taxes gone up? They've gone up either for wars, because they had to fund them, or social programs. Our concern is we haven't had increases in the last, say, 10 years or so for baby boomers and the social programs of Social Security, Medicare, Medicaid. We haven't had any rate increases really for Iraq or Afghanistan, other than those little blips there. And then we can't forget about our $21 or $22 trillion debt out there. How do we pay the debt off? Well, the government has to earn money. So taxes is what they'll do there. That's why we think the writing is on the wall, because those social programs need to be preserved and held in for the baby boomers and generations are coming right after them. So the government has to find a way to pay for them. So that's the whole point. So tying money up, postponing taxes today may not be the best strategy. We're not saying you shouldn't do it at all, but we need to think about it and kind of monitor and maybe have a combination plan. Okay, interesting slide here. Most people have never thought about this, but there's really 2 types of assets that you can own. There is an OR asset, which basically you're saying, because I can write it easy, get $100,000, and you could decide, I either want to have it in mutual funds, or whoops, now I want to have it in real estate. If you only have $100,000, you can't have it in both places at the same time. You have to decide, do I want it in mutual funds or do I want it in real estate? So you have limits if you're using OR assets to what your money can do for you. Not saying there's anything wrong with OR assets. We have to have some OR assets out there. And most people don't even realize the AND asset exists. So the place to store money is in what we call our cap plans, the cash value, the specially designed life policies. So how does an AND asset work? Well, your cash values basically are your assets, and you can loan or you can leverage, you can borrow against the cash values, you can use them as collateral. So as an example, if you had the same $100,000 down here and you had it over here, you could maybe come over here and put $100,000 in real estate. Now, if you remember and have read the book, your cash values never leave your policy. You have borrowed against the cash values, and your money is still working inside that policy. You can see down here at the bottom. They earn the same interest rate, same dividend as they were when you hadn't utilized them or leveraged against them. So in this example, with the AND asset, you've got real estate that's growing and providing cash flow and wealth. Your same money is working in 2 or more places. So if you think about it, if I ask every one of you tonight that's on the call, would you rather $100,000 work in one place for you or $100,000 work in 2 places for you? So the leveraging of the AND asset is, the primary thing that people have used forever is what's called OPM, other people's money. That's what's called leveraging, and that's exactly what we advise our clients, our dentists, to do, is use that leveraging and having money working both places for you. So we're starting to get a little tight on time tonight, so I'll kind of get through in here. So always remember, you should want and you need to be in control of your money, both your cash and your cash flow. Whenever you don't have that, you're in jeopardy, either of missing opportunities or being caught up in paying a lot more money for things you have to go get. To become very successful and wealthy, as I just mentioned, you need to use other people's money. In other words, you need to leverage your money to create more wealth. Not that you as a dentist can't be very successful financially, but you're still, if you don't use the OPM and leverage, you're not going to be as successful as you possibly could be. So depending upon where someone wants to be, how they want to get there, etc., that other people's money is really, really important. Depending upon where you put your money, you could lose both number one and number two. If you remember that first screen we talked about, taxes, time, access, the old luck. We want luck on your side. Well, if you have luck on your side, you're taking advantage of both number one and number two here. That's why it's so important to understand where you put the money to take advantage of both of those. And again, it doesn't mean that you shouldn't have money in a lot of places. You should. But it's important to understand number one and number two. It can be you're just getting started, or you're making some midstream changes in a practice as it's growing. You could be any place in this continuum of getting started to a senior dentist getting ready to get out. It's never too late to put yourself in control of the money. We talked last time. You see the money growing over here, dollars and dollars. Remember, you owe it to yourself, your family, and your practice. The banks don't need to win. Traditionally, I can't tell you any dentist we've ever sat down with that the bank wasn't winning in a larger sense than the dentist was winning. We can help you turn that into where it's for you, your family, and your practice instead of the banks. We want you to win the banking game. We want you to be able to set up and control it. Have that luck factor on your time, on your side. So we've got a couple questions that came in. I'm not going to take too much longer. We really want to thank you for taking the time this evening. It's a little hard to see down here in the bottom, but head to the website. There's an awful lot of information out there. There's a lot of tax-free information out there. It's important that you do the homework, because then when you talk to Greg or I, because again, you get a free 30-minute conversation with us on a personal basis just for spending the time tonight with us and reaching back out to us. And remember, we don't have email addresses or phone numbers for a lot of you, so you need to reach out to us so we can get on the schedule to help you see if this kind of planning would make sense for you. So anyway, let me take a look at a couple of questions here tonight. I need to put my glasses on for this. First question came in, it's a great one. How do student loans or practice loans come into play with investments? Well, I counter that with a it depends. One of my good friends, Jim Bolts of Zimmerman and Bolts, very seldom is a question that he's asked isn't answered with it depends. Well, what could be a problem is if you still have student loans and practice loans and you're investing money, you're taking risk on the money, but you've got finite dollars that you have to pay back to the various institutions that you'd borrowed. So in many cases, it makes sense to at least understand how's the time frame of paying back, how much risk do you want to take prior to being able to get those other debts paid off. Next question says, if I can put dollars into a 401k, Roth IRAs, or IRAs, should I do it if I have existing loans? Well, again, that depends. Is an example. Let's say you have an existing loan, and we see a lot of student loans and even some practice loans out there that are in the 6 to 7% range. Well, if you could utilize money and pay off a 7% loan, what rate of return do you think you're making on that money? Well, it's effectively you're making a 7% rate of return because you're getting rid of a 7% loan out there. Now, if you do that, the downside to that is if you pay that loan off, let's say it's $50,000. You pay that off, how much money do you have left? You have zero left because the banker or the student loan company has gotten that $50,000. Now, if you're using our cap planning philosophy and using and loaning against your cash values, now what's happened? You basically have taken the money, paid that off, you've got your and asset working for you, and it's continuing to earn interest, and when you put $1 back into your cash value's gone up by that $1. So you're recouping all those dollars so you can use them again. Very, very important. One other question real quick, last one for tonight. How can I use other people's money? Well, you can either use other people's money by very traditionally going to the banks, and you use their money to be able to buy the practice, get the equipment, or anything else. Now, will that make you money? Sure. Dentists have done it forever. They've borrowed money, they've paid it back, and they've had very successful practices. But if you think about it, if we come back to other people's money using your cash value, if you could have, in my example, that $100,000 working for you in your cap plan cash values, but you just use the $100,000 to pay off a cone beam machine, and now your practice is paying that money back to you, so you've got basically your $100,000 working two places at the same time, that's a whole heck of a lot better than using the bank's money if you don't have to. Now, you can't get there overnight. It takes a while to develop the money. This isn't a get-rich-quick scheme or overnight. But as you build it, it becomes very, very, very successful and works very, very well. So anyway, that's all the time we have for tonight. Greg and I really appreciate your time. Thanks for spending it with us. Everybody will get a copy of this. We'll be posting it out on the website. So hopefully all the audio and video and everything else worked well tonight. And thanks again for your time. And we'll talk to you the next time. Sometime in March, we'll be getting back to you. Thanks a lot. See you next time.
Thank you, Rich.
Thanks, Greg.